All right, so let's look at part C. So here, when you have long-term contracts, you have to consider all 5 steps, but mainly steps 2 and 5. So step 2, identifying the performance obligations. Well, here, when you're building, for instance, a building, uh, even though, again, there's boards, plumbing, concrete that I guess could be considered single or separate performance obligations. When somebody is wanting a building built, they're looking for a building, not the separate parts of the building. So really here, what you're looking at in long-term contracts for a building is a single performance obligation. As far as step 5, of course, you recognize revenue when or as each performance obligation is satisfied. And here, when you're recognizing revenue over time, according to the process or progress towards completion, usually long-term contracts qualify to recognize revenue as they build it. And usually that's built into the contract on when they recognize. So here we have an example that's kind of a running example for C, part C. And so here we just have some basic information on this example. At the beginning of 2018, Harding Construction Company received a contract to build an office building for $5 million. They'll construct the building according to specifications provided by the buyer, and the project's estimated to take 3 years to complete. According to the contract, Harding will bill the buyer in installments over the construction period according to a prearranged schedule. Information related to the contract is as follows. So in 2018, they had construction costs of 1.5 million. You see that that is also the cumulative actual construction cost for that first year. They estimate that it will cost an additional 2.250 million to build, so the total estimated construction costs are in 2018 3.750 million. In 2018, they billed 1.2 million and they collected 1 million. In 2019, they incurred another 1 million in construction costs. They already constructed or incurred 1.5 million, so the cumulative total is 2.5 million. At the end of 2019, they estimate an additional 1.5 million in costs to complete the project. Notice it's a $5 million contract, so that's fixed. What's not fixed is the estimated costs. It's not unusual for costs to go up, and what that does is it eats into the builder's profit margin. And at some point, they can actually lose money or, maybe break even, lose all their profit margin is my point. All right, so anyway, so now at the end of year 2, they're estimating 4 million. So already they've eaten into their profit margin $250,000. Billings made year to date for year 2 is 2 million, and collections during the year is 1.4 million. In that last year, year 3, construction costs incurred during that year is 1.6 million. They've already incurred 2.5 million, so total construction costs are 4.1 million. Since it's built at the end of 2020, year 3, that's all the construction costs. There's no more construction costs to be incurred. Billings in that year were 1.8 million and cash collections 2.6 million. Okay, so that's just some basic information there. Some of the journal entries you'll see with this sort of deal are the following, and I'll just go through one example each, and it'll be 2018's. But you have something called construction in progress account. This is similar to what you would see in work in process inventory in a manufacturer. Okay. And then their expenses. Assets out, if you will. Cash for the purchase of materials that they already have. In the second example, the amount billed is accounts receivable. So debit accounts receivable. You credit a corresponding amount to a contra asset account called billings on construction contract. And the reason why you do that is because essentially if you don't, you're going to be double counting your construction in progress and accounts receivable. So let me make sure I got that right. On page 263 it says, to understand why we use the billings on construction contract account, consider the key difference between accounting for long-term contracts and accounting for a more normal sale of inventory to a customer. In the normal case, the seller debits an accounts receivable and credits revenue, and also debits cost of goods sold and credits inventory. Thus, the seller gives up its physical asset, inventory, and recognizes cost of goods sold. At the same time, it gets a financial asset, an accounts receivable, and recognizes revenue. First, the physical asset is in the balance sheet, and then the financial asset, but the two are not in the balance sheet at the same time. So here, if you didn't have the billings on construction contract account, what you would have is the physical asset of construction in progress and a financial asset, accounts receivable. You can't have both. And so it says that Harding is creating a physical asset, the construction in progress. In the same period, it recognizes a financial asset, accounts receivable, when the customer is billed. Having both the physical asset and the financial asset in the balance sheet at the same time constitutes double counting the same arrangement. The billings account solves the problem. Whenever an accounts receivable is recognized, the other side of the journal entry increases the billings account which is contra to and thus reduces construction in progress. As a result, the financial asset decreases and no double counting occurs. So that's why you're doing that. Kind of a long, drawn-out explanation, huh? All right. And then last but not least, when you receive cash, you're going to debit it and back out your accounts receivable. As far as revenue recognition is concerned, here's what that would look like as far as um, the entries. And what they're looking to show you here is if for some reason you could not recognize revenue over time, you have to recognize it at the end of the contract. Well, that first, the top entry illustrates that point. So construction in progress, 900,000, debit, cost of construction, 4.1 million, and revenue from long-term contracts, 5 million. Now, down below, this is how it's normally done when you're recognizing revenue over time, which is most construction contracts. And we'll look at how you figure out these amounts in a minute. But just notice that you've got your cost of construction in that first year of 1.5 million. You've got your revenue from long-term contracts of 2 million. We'll show how that's determined here in a minute. And then you've got construction in progress, 500,000. We'll show how that is figured out as well. But notice total revenue over the contract, though it's recognized at different times in one and it's recognized all at once at the end of the contract, at the other is the same amount, $5 million. Notice that the amount of, let's see, oh, okay, so this is recognition upon completion of contract. Notice in the billings, what you've got here is in the billings on construction over time. Well, either way, it's going to be 5 million, and the difference is in the 4.1 million that's of costs that are billed and, excuse me, incurred and then billed is their gross profit. And then notice it started out to be 1.2 million and $50,000 because the contract was for 5 million and the estimated cost was 3.750 million, but because of increased costs, their gross profit ended up at the end of the contract being 900,000. All right, so how do you recognize revenue over a certain period of time? Well, what you have to do is you have to take your total estimated revenue times the percentage completed to date, and then from that subtract revenue recognized in prior periods. Now, how do you figure out the percentage completed to date? Well, what you have to do is you have to take the actual cost to date, which in that first year is 1.5 million, as we've seen. Then, so that's your numerator. And then the denominator is total cost in that first year, estimated total cost was going to be 3.750, and so 40% of the contract is complete. So you take your contract price of 5 million and multiply it in that first year times 40%. And so the revenue amount you recognize is $2 million. So that's where you come up with revenue for that first year. So you've got your cost of 1.5 million, you've got your revenue of 2 million, and so the difference, it goes to this construction in progress, but it's actually a essentially a gross profit amount. And then of course when you have to notice here, let's go back. Notice in that second year, you've completed 62.5%, so 3.125 million is the amount you're going to recognize, but you've already recognized revenue of 2 million in that first year, so you have to subtract that. Okay, so that's what they're doing up here. And what you get in that second year is revenue recognized of 1.125 million, and so on and so forth for that last year. Okay, so that's where you're getting these numbers. Revenue from long-term contracts is your credit, cost of construction is one of your debits, and basically a plug number is the difference between the two that goes to construction in progress, and essentially it's your gross profit. And so in your income statement for this construction company, it would look like this for the first year. Revenue recognized of 2 million, cost of construction 1.5 million for this job. Gross profit is the difference. Same for the second year, same for the third year. Note that they build, and I'm really more paying attention to the projects recognized over time. I'm not too concerned about your knowing what to do on the recognized on completion, because I don't think I give you any problems like that, and it's not too common. It's really more about revenue recognized on projects over time. And if you recall, they had billed 1.2 million, but they received 1 million by the end of the year. So the difference is what you see here in accounts receivable. Now the other thing you've got is something called costs and profit. Okay. So costs in that first year were 2 million. Profit in that first year was another 500,000, so that equals 2 million. They only billed 1.2 million, so they recognize an asset here of the excess between the two. So they call it costs and profit in excess of billings. So some special kinds of accounts for construction contracts or construction companies that have these kind of contracts. Now note, you could have just the opposite. You could have billings in excess of cost and profit. So in that second year, that's exactly what happens here. Uh, they have billings of 3.2 million and costs and profit of 3.125 million. So that's a difference of 75,000. When you have billings in excess of cost and profit, you have to recognize a liability. And so that's what they've done here in that second year. All right, so let's test our knowledge here. Robertson Construction entered into a contract to construct a tunnel for a fixed price of $12 million. Robertson recognized revenue over time according to the percentage of completion. Here are some facts. Okay, so 2018, 3 million cost incurred, additional cost to complete of 6 million. So it's going to cost 9 million estimated in that first year to complete total. So their gross profit is going to be 3 million. Cost incurred in the second year is 500,000. So estimated additional cost to complete is now 6.5 million. Last year, costs incurred 6.5 million. Additional cost to complete is 0. So the question here is, what is Robertson's percentage completion in 2019? Okay. So the answer is 35%. How did they get there? Well, they basically did this. At the end of year 2, they incurred total of 3,500,000, and they're expecting to bill total here of 10 million, which is the 3 million incurred in 18, the 500,000 incurred in 19, plus the additional 6.5 million they expect to incur in the future. And so you take the amount of costs incurred to date here at the end of 19, which is 3.5 million, and you divide it into the total cost, which is going to be 10 million. Robertson Construction entered into same deal, just some different numbers here. Costs incurred in 2018 is 3 million. Estimated additional cost is 6. Costs incurred in 2019 is 5 million. Additional cost is 2 million. And they actually incur 2.5 million in that third year. So question is, what is Robertson's percentage completion in 2018? So that's a real easy one, right? 33 1/3. You could eyeball that one. All right, same basic, except here, what are we saying? What is Robertson's percentage completion in 2019? So you've incurred 8 million total. and you've got an additional 2 million, so 80%. So see how easy that is. Robertson Construction entered into a same thing. So cost incurred 2018 3 million, additional cost to complete 6 million. So how much revenue would Robertson recognize in 2018? Well, they're 33.33% complete, 1/3 complete, right? Total contract price is 12 million, so they're going to bill 4 million. Okay, same basic deal. Except here, how much revenue would Robertson recognize in 2019? Okay, so here, costs incurred 3 million in 2018, another 5 million, so 8 million total. They're 66 and a third, 2/3 complete. Are they not? No, they're 80% complete. Okay, so they're going to take 9.6 million minus, what did they have? 9.6 minus whatever they had before, 33 and oh, 9.6 minus 4. So B is the answer. Kind of hard to do in your head sometimes. Probably best to put it to paper. All right, next, same basic deal. How much revenue would Robertson recognize in 2020? Well, let's see here. What have they recognized so far? 9.6 million, so 2.4 million. 12 million minus what they've already billed. All right, don't worry about long-term contract losses. I don't think I can give you anything on that. If you get something in the quiz on it, just let me know. And if you get it right, bonus points. If you get it wrong, I'll count it anyway. Okay? All right, so that's it for part C.